Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is July 27th, 2023. Today we're going to ask the question, is GDP driven by GPT? Looking at the chart and today's move, you can see that the equity market gapped up and is closing down. They're trying to fade down. That's not a good sign necessarily for a continuation higher. We see the gap up and close down as an exhaustion gap, which means it wants to get back to refill the original close from the previous day, and so it probably is going to drift back down to 455.50 by the end of the day or first thing tomorrow. So the gap up close down does not seem like it's supporting the bullish move in equities, but that's not what we're here to measure today. As we're looking at the market, we want to know, is the GDP, the outperforming GDP, being driven by AI? Is it being driven by GPT and the next move in technology? So as we're looking at Advance GDP is the number one of all the GDP reports. We have Advanced, Preliminary, and Final. It is the number one mover of the markets because it is the earliest indication of whether we have growth or not. Now we will look at some of the revisions and some of the things that have happened in conjunction with that. And anytime you revise higher, that means more growth. Anytime you revise lower, less growth, and so forth. But we've seen not only have we turned positive in growth since October of 2022. We've revised higher in more cases than we have lower. But you can also see that we've outperformed. The Fed has determined that their target rate, they want to see between the 2% and 3% GDP and a similar inflation number. Well, our GDP numbers are holding near that 2 to 2.5%. We saw it expected to come in at 1.8 and it came in at 2.4. This disrupts any probability of a recession for at least the next 2 quarters. So advanced GDP being above 2.4% is telling us that we are going to continue to see growth. We'd have to see a major slowdown to see even next quarter go negative. So realistically, we could argue that we won't see the true signs of a recession for at least 3 quarters. Therefore, we're out into 2024. And that should be a great thing. But what does that really mean? Is GDP being driven by this idea, this speculation of GPT and AI? As I started out with the SPY gapping up and closing down, an indication that we're going to probably fade and fill the gap. The move that we're seeing is not being supported by only AI. Yes, the gap up and the responses responding to Meta, and Meta saying, oh, we're really looking forward to the future. It's good, bright. Everything is wonderful, and we're going to see some significant growth. We gapped up, closed down, and we're doing the same exhaustion gap in Meta as we saw in the SPY. So all of the SPYs moved today, and the sell-off and the return back to the original price is telling me that we probably don't have true growth coming out of AI. If we look at the previous reports and the expectations, you can see they came in at 298 versus the 286. Small outperform, but we've seen a lot of small outperforms by the technology sector. This is not a justification or an indication to see a 10% forward projected move. It's off the guidance that Meta says that we're going to see a huge growth and a major return and an upswing in advertising, which is what they're claiming. Are we really seeing the movement here? Well, if we take a look at the other stocks that are the drivers of AI, we can see Google is held way up here, and looking at its earnings is expected to be 131, and it beat it at 144. Is that a justification to push it up to these levels? Same thing, we could even use Amazon. Amazon is going to have some influence in that sector, but not really changing much, but we do have earnings up and coming. What I want to see is the movement today really what is driving the overall health of the economy? So those little tiny wins, we're not talking about 2%, 5%, 10% on some of the largest companies in the market. When we see Meta and Microsoft, who is down a percent today, and it's a $2.5 trillion market cap, why are we not seeing more growth in Microsoft? Microsoft is slowing down and struggling, and we see Google's up and Meta's up a lot, and you see some of the companies that provide parts for AI, and they're up. Is that going to be enough? Are we really going to see the growth in demand? And one of the things I was looking at today is NVDA. And if we take a look at NVIDIA and we see the huge spike and the move up, are we seeing the justification, the growth in NVIDIA to justify the growth projections of Meta or Google or Microsoft. Let's take a look at NVIDIA. NVIDIA is going to represent the supply chain feeding into AI, because we're not talking about NVIDIA writing code or becoming AI, but they have to have the processors to be able to deliver the AI and have the processing power. So NVIDIA should be growing at a relative rate to what we're already seeing in the demand for AI. So if AI's demand is going up, we need to have a lot more processors. We need to have a lot more growth. We need to have a lot more expansion in NVIDIA. And if we look back at the last year, $1.0988, so we were looking at about almost $1.80, $1.90, or sorry, $2.80, $2.90 in earnings over the last year, when the stock is all the way up at $4.70. Is that reasonable? It is a 250 price to earnings ratio. For the trailing 12 months, NVIDIA is trading at 250 times its earnings. So if we're looking at that level, that is amazing to think that we are assuming that the next 250 years of earnings are currently being priced in NVIDIA. Why are the orders not going through? Why is NVIDIA not making profit that would be relative and consistent with what we're seeing in Google and in Microsoft and in Meta? If we go back even further, we can see that the demand for NVIDIA spiked when we were thinking that we needed more processors for crypto. And during that time frame, not only did we get a 4-to-1 split, we can see we were making 290, 310, 366. And so looking back here and looking at the earnings that were going into this, we had approximately $12 of earnings in the trailing 12 months at a $167 price, which means that we were looking at a PE ratio around 15 right before it exploded out of this. Now, when it was exploding and climbing higher, this was forward looking, right? We need more processors, we need more processors. But while prices rose, your earnings actually fell. And not only did earnings fall while prices were going up, your PE ratio became ridiculously high. And so looking at that ridiculously high PE ratio at the time, after that October-November earnings report, your earnings had slid down to 9 and your price was all the way up here to about 330. Even then, your PE ratio was only 35. So the fact that we're almost near 250, 240, 250 PE ratio here, while earnings have dropped down to 50 cents, 58 cents, and yes, we're recovering, 88 cents, $1.09, we are seeing some growth in demand through here, but the growth in demand and the growth in earnings here are not being reflected at the right pace, the same pace that we've seen prices get all the way up here to 469. So as I would look at it, NVIDIA is being overpriced and showing that we are not driving this based off an actual increase in earnings to justify GDP's growth. We're speculating that GDP's growth is going to go higher. We're speculating that NVIDIA's demand is going to increase. And if we're going to go back to the same peak that we saw before, either we have to see earnings increase through here to get us back to that same ratio to be $13 to $15 annualized earnings, or we have to see prices fall to match this $3, which would indicate that we'd see about a $100 price in NVIDIA. One of the two, or maybe a combination of the two. But it definitely seems like NVIDIA is way too high based off of earnings, expectations, demands, and the previous trends that we saw during a previous forward-looking demand for earnings. So what is driving GDP? As we look at the charts and we look at the movements here, one of the reports that came out is durable goods. Now you can see manufacturing has increased a little bit, consumer confidence has increased a little bit, home sales have slid. So really the next big green thing down here is when we're looking at durable goods orders and core durable goods orders, and that was a sizable bump. Core durable goods orders and durable goods orders are representative of the stuff that has a longer lifespan. This is not a throwaway type of product. So durable goods would include appliances and cars, generally speaking. Those are your two major indicators. What's driving this GDP up to 2.4%? Apparently, appliances and cars. Durable goods rising 4.7%, lifting that area of the market of the long-term big ticket items that last for longer time periods, and we generally don't spend that money on durable goods. We generally fix them instead of buy new, unless we're feeling confident about the economy. So the economy is growing because we're feeling confident, and because we're feeling confident, we're buying more durable goods. And when I think of appliances, the number one thing I think about is GE, because it's one of the largest companies that provide appliances and other durable goods. And GE is all the way up near its record highs. Now, being record highs, like we just saw in NVIDIA, does not necessarily mean you're making money. And your PE ratio can get completely out of whack, getting as high as, like I said, 240, 250 PE ratio. Well, GE's PE ratio currently is only at 13. Now, 13 PE ratio, maybe in history would be a little bit expensive as far as a conglomerate like GE, but it is not in this environment. So GE is at 13, and you can see, based off the price, 116, we made 68, 27, 124, and 35. So we've made roughly the same amount in the last year, profit-wise, per share, earnings-wise per share in GE, as we did in NVIDIA. The difference being this is trading at 1/3 the cost. And so looking at that PE ratio of only 13 or 14 for GE, this appears to be driving the market higher as far as actual growth in GDP's numbers, gross domestic product. Now, one other thing I want to remind you of, GDP, when we're looking at consumption of items, GDP, gross domestic product, 55 to 60% of all GDP is consumer spending. Now, ask yourself this question: how much have you spent in the last year on AI versus how much in the last year have you spent on cars, on general consumer products, on appliances? I know I bought a new set of LG washer and dryer just this last year, so I'm part of that durable goods increase over the last year. As we're looking at the prices move up here, GE is not only at its highs, but it's not overpriced at 13 times price to earnings ratio. If we look at the automobiles and the automotive industry, are we seeing the growth there? Toyota is at 166, and if we look at its PE ratio and look at its earnings, 283, 366, 308, a lot more profitability in earnings that are driving gross domestic product. Now, Toyota is produced, yes, in the US and in Japan and in Mexico, but we do actually have Toyota Motors in the US, and that is driving some prices higher as well here. So let's take a look at something maybe the more domestic. Ford, and Ford prices, oh, I forgot to tell you, Toyota has a 12 PE. Ford has a 19 PE, and not quite as high, but you can still see making more money per share at a lower price. General Motors also sitting here at a 5 PE. General Motors sitting at a 5 PE and near its previous highs. $1.91, $2.21, $2, and I can't see this one. Let's compress that down, $2.25. And so General Motors is making nearly twice the amount of earnings per share as NVIDIA, and is trading at nearly 1/10 the cost, giving it a 5 price to earnings ratio. And it's not because I'm saying that GE is a bargain and you should go out and buy GE, but I'm telling you what is actually driving spending and growth. Well, if they're making this per share in earnings, and GM is still holds one of the largest percentage of the market share of automotive purchases, this is a bigger driver towards GDP than NVIDIA or AI in general. And let's finish up with the automotive industry with one of my favorites, is Honda Motor Company. Honda Motor Company, if you look at their earnings, they're at 11 PE, 11 times PE ratio. You can see 60 cents, $1.76. So very similar earnings that we just saw in NVIDIA as far as dollar for dollar, but it's a $31 stock, not a $400 stock. So again, there are drivers of the economy. There are drivers of what's being measured into gross domestic product, and NVIDIA is not one of those drivers. When you're not making the same amount of money and your cost a lot more to be able to buy that stock, these are not the bargains we look for in NVIDIA, but we probably are looking for these things that are going to drive the economy longer term and have a history of providing both a dividend and a growing earnings per share. Now, to leave the automotive and still focus a little bit on durable goods, one of the things we'll look for is computer hardware. We're not talking about NVIDIA as far as processors, we're talking about computer hardware. So I'm going to look at Dell and HP. Now, you may not think that Dell and HP are worth owning, that you might think that, oh, they're the dogs of the market. Well, take a look. Take a look what's going on with Dell and HP. Not being driven by anything other than what they do and what they have done for decades. Dell is near its high. Dell is at $54 a share and has been climbing. You can see it, earnings that it makes per share are much higher than what we saw in NVIDIA. And if we're looking at Dell currently, as far as the PE ratio is concerned, it has a 20 PE ratio, and its return on equity has increased by 50% year over year. It's uptrend. It's been uptrending every year for the past 5 years. So Dell has provided great returns, has seen 50% return recovery off of this while backing it with earnings, not just speculation. Even HP, which has been another one that has been knocked down quite a bit, has seen nearly a 50% rise off of its lows and has a similar about $3 earnings per share at a $33 stock instead of a $450 stock. So is it going to be easier for a company that is making profit to continue to climb versus NVIDIA, who is making profit but making a much smaller return and earnings per share down 120% year over year compared to some of these durable goods, these durable good companies? Restoration Hardware is a high-end home furnishing company. So if we're looking at furniture, you can see here's another great example. Here's a stock that's closer to what we saw price-wise of NVIDIA. And if we're talking about durable goods, furniture is definitely one of those durable goods type of items. And we're at $394, so similar price. The difference here is the PE ratio on something like RH versus NVIDIA. The PE ratio is 26. The earnings per share is down a little bit from a year ago, but you can see that we have a lot higher earnings, $8, $5, $3, and $2. So we're talking about nearly 10 times the earnings for a similar price stock. So I'm looking at the trajectory of these core durable goods and the durable goods, saying that if we are seeing a return back to buying of durable goods and pushing up to these higher levels at a 4.7%, this is feeding into our GDP a lot more than AI is. AI is not driving GDP. AI is driving speculation in AI-sensitive stocks. GDP is being driven more by consumer confidence, consumer sentiment, and durable goods orders than anything that we would see in AI. The speculation is not being priced in to GDP. GDP is representative of actual gross domestic product increase, not speculation and driving prices higher. For a fun one, let's just go throw Yeti on in there. I don't know if you're a fan of Yeti or if you have someone in your life that is a sociopath when it comes to Yeti items. I just thought it was funny that Yeti was considered a durable goods company, being that evidently these Yetis last a long time. So the drink that you fill your icy drink in or hot beverage in, Yeti is a durable good item. And, you know, what is the expectation? It's more of in a hold situation. It's not in a growth situation, and just kind of maintaining this at 50 to 1 price to earnings ratio. But even then, at 51, it's a better deal, a better bargain. As we're sitting here, do you think that a company like Yeti can maintain its price versus something like NVIDIA that is already trading at 250 times valuation? Do keep in mind that Tesla did reach nearly 1,000 price to earnings ratio, but it doesn't mean that it maintains that. So you watch for those peaks, those things to become overvalued, overpriced, watch for a correction, and then buy back into something like NVIDIA. But these other stocks that are durable goods can be an opportunity to buy now or sell puts on now to be able to build a position over time. They have a higher likelihood as their earnings per share are maintaining and increasing, and their PE ratios are relatively low, to provide you a long-term investment into the durable goods, assuming that GDP is stabilizing, growing, and predicting that we are a long way away from a recession, despite the increased rate of 5.5%. Now, pushing it to 5.5%, that may see a slowdown, but a slowdown here is not being reflected in consumer confidence, is not being reflected in durable goods orders, and is not being reflected into advanced GDP. So it looks like we are a long way away from a recessionary move, and that the 5.5% rate was not enough to crush demand. And so this could tell us two other things. One, buy the stuff that's stable and strong while it is stable and strong, and maybe assume that we are going to see another 25 basis point hike in September as growth continues to move higher. And I said Honda Motors was probably my favorite as far as car companies go, the ones that we looked at. And as we're looking at this, we're somewhere in the middle. I think you could probably get a reasonable premium to sell puts on Honda, as their implied volatility is somewhere in the middle of the range of the last year. And looking at the Honda Motors as far as price action on a put, they do not have weekly options, so you would have to look out to August or September to be able to sell puts on that move. And again, we're almost exactly mid-price at 47% implied volatility versus historical volatility. So taking a look out to September, you can actually collect about 1.5–2% by selling puts at 30. If you were to sell at the money or in the money, you could collect nearly 10% as long as we can get back up to those previous highs. So watch for some opportunities to sell premium to build a position for longer term trades in companies that benefit from a stable economy, higher growth, consistent growth, and durable goods. It's not speculative. You're not going to see the massive returns, but I think it's going to be harder for these companies that are already pricing in super high prices to continue at that rate compared to a company that's showing that it's stable and growing. That's going to do it for me today. Have a great day, everybody. We'll look forward to talking to you again next week.